This past Wednesday, September 22nd, 2021, the market saw the debut of IPO Toast, which is a company that offers a point-of-sale system for restaurants. Now, investors who bought the IPO at the price of $40 a share saw quite the return. By the end of the day, their shares were up 56% at over $60 a share. Now think about that for a moment. 56% in a single day. That means if you had made a $10,000 investment in Toast, by the end of the day, it would have been $15,600, all in a hard day's work. Here's the fact. You can stand to make a lot of money if you pick the right IPO and watch that valuation climb like there's no limit. In fact, do a quick Google search and you'll find articles suggesting returns around 900% if picking the right IPO. That kind of return is alluring to any investor. And none of us is immune to the siren's call. Now, you can also make a lot of money if you go to the racetrack and put your money on the horse that ends up winning. Or bet on a sports game or head to the local casino. Because see, that's the catch, isn't it? We just don't know. And after all, investing in an IPO truly is a gamble. You see, Toast could just as easily gone the route of so many IPOs who start strong with a solid valuation but get destroyed by the market. According to CNBC, more than 60% of IPOs from a selection of 7,000 that debuted between 1975 and 2011 had a negative absolute return after 5 years. See, first-day returns can be misleading. If you take the case of Oatly, which is a creator of a plant-based dairy product marketed to baristas at coffee shops, you look at a stock that debuted at $17 a share on May 20th. It soared 30% immediately, then tapered back a little bit, but still finished strong. Flash forward a few months, that stock is now $16 a share, which is below the IPO price. And investors will say, you have to know the company, you have to know the product, and they're right. But there's more to it than that. Personally, I love Oatly. I've regularly used their products, and I fully believe they would do well. I mean, it's plant-based, it's better for the environment, it can make some mean latte art. It looked like it was going to be the next Beyond Meat. If you remember Beyond Meat, they had an IPO of $25 a share. They hit $234 a share within a few months and poised for awesomeness. And currently they're trading down from that high around $109. But that's still over 400% of a return. Now, did I personally invest in Oatly? No. Am I glad I didn't? Absolutely. Here's an example of a more detrimental stock. GoHealth. GoHealth debuted in July of 2020 at $21 a share. That stock, it's now $5.13 a share. Here's another one for you. Sundial Growers. This is a cannabis producer from Canada. The IPO in 2019 was for $13 a share. And then problem after problem after problem. And now it's 67 cents a share. That's a loss of 95%. If we jump back to our $10,000 example, you'd be left with $500. And that hurts. Now, does it hurt as much as feeling like you lost a great opportunity? Only time will tell. But at least with the missed opportunity, you still have your original investment. Because in the end, we just don't know. That's why here at the 12% Solution, we tend toward the safety of diversification, allowing our wealth to grow while hedging our investments and taking full advantage of the time value of money. Besides, with a 12% return year after year, your investment will double in just 6 years. And while that may not be as sexy as a 56% return in a single day, it definitely will help you sleep better at night. And maybe that's a bit more important overall. Does that mean that you should never invest in an IPO? Not at all. In fact, it can certainly be a fun ride as long as you're willing to lose whatever money you put in. And also assuming that you're involved early enough in the process to see those returns. Investors who got excited about Toast after the first day were in for disappointment the rest of the week. If you bought in at $61 a share, you're now sitting at $55 a share. It's still a great return for the initial IPO investors, but that's down about 10% for those who bought after Wednesday's craze. So in the end, watch the craze, follow the craze, read about the craze, but do what's right for you and your investment portfolio. Hey, thanks for watching and happy investing.